Welcome back. Well, today we're going to talk about how bonds perform under various market conditions. And then the last time we spoke, we mentioned that in bull markets, uptrending markets, we see the 10-year bond and the longer term bonds, those tend to lead the market higher. And in bear markets, the short-term bonds like the 1 year or the 1 month tend to lead the market lower, which is true to an extent. However, it's a bit more complicated than that. So what we're going to do is examine various market conditions and examine how the bonds performed under that period of time. Now, the blue line here represents the 10-year bond. This is from 2009 through 2023, so quite a bit of time. The red line represents the 1 month bond, the very short-term bond. Again, the 10-year is the blue line. The black line, if you can see, is the federal funds rate. Now, you'll see the federal funds rate tracks very closely to the 1 month bond. In other words, the shorter the maturity, for example, a 1 month bond, those bonds tend to move closer to the federal funds rate. The 10-year bond moves in anticipation of higher or lower interest rates, to be sure, but also in respect to longer term macroeconomic forces. Now, first off, let's take a look at this is April of 2003 through May of 2006. Now, the yellow line, or the yellow area chart in the background, is the S&P 500. That moved from level of below 1,000 all the way up to almost 1,500. Now, the blue line represents the 10-year bond. You notice the 10-year bond remained rather steady around the 1,400 level. I'm sorry, that's 1,400 for the S&P. The 10-year bond around the 4.5%, actually 3.5 to 4.5% trading range. Now, that was between, again, 2003, 2007. But notice what changed. The red line, the 1 month bond, moved from the 1% level up to the 4.5% level during the same period of time. In other words, as the stock market moved higher, the economy grew stronger and stronger between 2003 and 2007. We saw the 1 month bond move up. Now, again, the 1 month bond closely tracks the federal funds rate. The federal funds rate moves in anticipation of higher or lower interest rates. So as we expect, as the economy grew stronger, and we expect the Federal Reserve to continue to raise rates, we tend to see the red line, the short-term 1 month bond, move up and eventually converge with the 10-year bond. Now, at one point, the 10-year bond fell below, or I should say the 1 month bond, the short-term bond, crossed back above the 10-year bond. That was the beginning of the inverted yield curve when the red line crossed above the blue line. Well, we fast forward to 2007 through 2009. The red line, the 1 year bond, was above and then crossed back below the 10-year bond. And we see in the yellow area chart in the background, the S&P 500 went from an uptrend to all of a sudden a downtrend. The downtrend consisted of the 1 month bond collapsing. Now, the 10-year bond, the blue line, also did go down to considerable extent from the 4.5 down to the 2.5, 3% level. But the 1 year bond, which is much more, we consider it a much more pure reflection of interest rates and the near-term expectation, moved from the 4.5% level down to almost zero. So the 1 year, the 1 month bond, the short-term Treasury, is really a lot more volatile and a lot more reactive. We can consider this another way. Think of the long-term bond, the blue line, the 10-year bond, as the long-term outlook, how we expect the economy to be in the long term, the distant future. The 1 month bond, the short-term securities, tend to reflect the immediate anticipation, how we think the economy is today, tomorrow, and the next day. Now, we fast forward now to April 2009 through 2015. The red line, the 1 month bond, you remember after the 2008 crash, was very much near zero, almost at zero. The 10-year bond was at the 3.5% level and drifted down to the 2.5, almost 2% level. The S&P 500, the yellow area chart in the background, moved from level of 1,000 up to 2,000. Well, we can ask ourselves, why did the stock market go up despite the fact that the 10-year bond did not? Well, again, the 10-year bond is a long-term projection as far as economic conditions. Those economic conditions may not be so great, but the S&P 500 is a reflection of future corporate earnings. Corporate earnings tend to excel under low interest rate environments. So even if the bond market is telling us, hey, maybe the economy doesn't look so good in the long-term future, companies are still able to borrow at very low rates. The 1 month bond, which is again very close to prime interest rates. So companies can borrow at those levels, investors can borrow at those levels. You can literally borrow at almost zero. So anything above that is pure profit. And that's why the stock market went up between 2009 and 2015, even though the blue line, the 10-year bond, was not really projecting a very rosy economy. Still, we can borrow near zero. It takes very little to make money. Now we go forward from 2016 through 2020. Stock market continues to go higher. At this point, we start to see more rosy economic forecasts in our future. How do we know this? The blue line, the 10-year bond, starts to trend higher. We go from the 1.5% almost to 3% on the 10-year. During the same period of time, the red line, the 1 month bond, moves from 0 up to around 2.25%. We see the stock market is very strong at the same period of time. Well, we know what happens at the end of 2019, early 2020. Actually, even before that, notice what happened. We saw the blue line, the 10-year bond, cross below the red. Now that occurred, and this is very important, that occurred May of 2019. Our COVID crash did not occur until the beginning of 2020. So we're talking about 7-8 months before that stock market turmoil took place. The bond market was actually forecasting weakness in the future. The long-term outlook forecasted by the 10-year bond was not good. It started to decline. And then the market started to react in the immediate future, saying, okay, well, not only does the long-term outlook not look good, but the immediate future also does not look good. And that's why the red line started to go down. And then, of course, early 2020, we see the panic take place, and both lines very much fell very, very quickly. Now, we fast forward from 2020. This is August through present date, more or less. And we see the red line very much near the bottom, near zero. After that COVID crash, we start to receive a recovery, though. Long-term interest rates, long-term economic forecasts start to look better and better as the blue line travels higher and higher. We go from the 0.5%, 0.65%, 65 basis points in the 10-year, up until this is February of 2022, around 2%, and the stock market moves in kind as well. Stock market goes up as the long-term outlook looks good, and we can still borrow at very low interest rates. That really is a perfect storm as far as strong stock markets. When we see the long-term bond move higher and we can borrow at very, very low interest rates, when the Federal Reserve keeps those rates very, very low. Well, unfortunately, that led to a great deal of inflation, at which point the Federal Reserve says, okay, we're going to have to start raising interest rates. Higher interest rates start to weigh heavily on the economy. We can see the yellow background chart starts to get very choppy. The S&P 500 is not doing well. This is from February 2022 through now present day, April 23. At this point, we're talking about November 22. We see the red line cross above the blue line. That's the beginning of our inverted bond yield curve. It crossed back and then crossed over again a little bit later, a few months later than that. We're talking December of 22. But essentially, we see the 1-month bond above the blue line. So what does this tell us? What does the current bond market tell us? The blue line is at 3.4%. It looks like it's in a trading range. It's not trending higher. It's not trending lower. It doesn't look tremendously optimistic or pessimistic, but it really is kind of like in the middle of a trading range. And that's why I think the stock market has failed to make any kind of significant move. The red line, the 1-month bond, is above the blue line. That's an inverted bond yield curve. It means that, well, in the near-term future, things may look rosy, but in the long-term future, we probably see lower interest rates. Now, we can compare present day, go back to what we saw for the markets, let's say 2003 through 6, The blue line, the 10-year bond, was above the red line, the 1-month bond, but then we saw the end of this tremendous bull market. The red line crossed above, and the stock market started to get choppy. Eventually, what was a signal that stock markets really began to go down? It's not only that the long-term forecast shown by the 10-year bond, the blue line, was starting to trend to the downside at a moderate pace. The red line, the 1-month bond, really started to fall precipitously. That was a signal that the stock market was really starting to break down in 2008. Now, I don't think we're there yet. Again, remember, this happened only after the 1-month bond crossed back below the 10-year bond. The 1-month bond, present day, is still above the 10-year bond. Now, two scenarios. If we see the 1-month bond cross back below the blue line and really start to drop very quickly, then I think that coincides with very weak stock markets. However, if we see the blue line cross back above the 1-month bond, meaning the 10-year bond starts to move higher, that tells us that the long-term outlook is starting to look better and better. So I think, again, it's really important. Does a red cross below the blue, or does a blue cross above the red? That tells us whether in the near-term future things start to look very, very bad, or the long-term future starts to look better and better. And I think the stock market will reflect in kind. We're going to come back to these charts on a regular basis and update you with any significant changes along the way. We hope this has been helpful. We look forward to seeing you back soon.